James Nixon is Chief European Economist at Societe Generale. He joins me now. So Nixon, thank you very much indeed for coming in. Good to see you. So this is quite a dilemma that Jean-Claude Trichet is facing, this rising inflation problem combined with a worsening debt crisis.
I think it is very much that they have these two sort of competing objectives. How do they contain, inflation not so much because it's expected to decline, but you've clearly got some of the northern European economies, Germany especially, almost on fire, booming away. And it's clear that the current level of interest rates is not appropriate for Germany. But as you say, on the other hand, there's this, the debt crisis just gets worse and worse. And yesterday was not a good day in the financial markets.
So, how is he going to address this? We know what he's going to do today, 25 basis point rate hike to 1.5%. But then, as you say, there's no sign that Germany's economy is going to slow down anytime soon. There's no reason to think that growth is going to pick up in the weaker peripheral nations anytime soon. So this is going to be a dilemma for a while to come.
Well, I think on the two things, on the interest rates, the key will be the language. And I think what the market is looking for is sort of any hint that the ECB might be about to flinch and maybe tone down a little bit more dovish, maybe, because clearly, when you look at the macroeconomic situation, it's not difficult to envisage further rate hikes later in the year. So, all the usual touch tones that maybe risks the price inflation is still on the upside. What we're looking for is him not to say that interest rates are appropriate. And these kind of nuances in language indicate that the ECB is continuing to raise rates later in the year. On the other hand, on the debt side, yesterday's developments, are potentially very serious, with Germany retabling this idea of a formal duration extension on Greek debt, and that's something that the ECB last month, could not have been more clear in their opposition to that kind of things. So we're really expecting him to very forcefully make that point again.
So why, when the ECB expressed its opposition, when there seemed to be some sort of growing consensus, possibly on a voluntary debt rollover for Greece, did Germany say, we want this back on the table now?
Well, you have to quibble as to whether there was a growing consensus. The reality is that when you look at the sort of, for example, S&P statement on Monday, and you look at how they assess a default, if it's a distressed exchange, if it's an exchange, for example, at a less beneficial interest rate, it's pretty clear that, the overlap between what S&P are saying and what the Europeans are sort of putting together, is a null set. There is no overlap. So it was never obvious that this was going to fly. And what Germany seems to be saying now is, okay, well, if that's the attitude of the rating agencies, well, then let's not sort of mess around with this sort of voluntary, complicated structure. Let's go for the full force, and let's go for a full
either
duration.
Option, whether it's voluntary or indeed a debt buyback, either option would trigger a selective default.
Potentially, yes.
Is there any way of avoiding that?
Well, I think that both the rating agencies and the ECB would say simply, don't go there. What we're dealing with is a relatively small amount of money in the scheme of things. It's really not obvious why you need to necessarily pursue as aggressively as you are doing this private sector involvement. And given the damage that it's doing to the financial markets, the fact that other countries like Italy are now coming under market scrutiny, that is a place that you just don't want to go. So let's give it up and just put together a deal. Is
that realistic? Is that possible at this point? Many people arguing that, well, some sort of private sector involvement, some sort of write down or hit or haircut, however you want to phrase it, is pretty much inevitable for private investors.
Well, I don't know if I would agree with that. The politicians, if you like, you can see, their point of view is that they have to be able to offer something to their electorate. Particularly in Germany and to a certain extent in Finland and the Netherlands, there's a sense that if you're just handing money to Greece and another bailout, the first thing Greece does with that money is use it to pay back the banks. So, there's a sense in which you do want to sort of, make the banks, take some of the pain. But the ECB, on the other hand, are arguing that it's very hard to actually do that in practice without unleashing, a wave of contagion that would really be very damaging for the euro area.
How much of if it's a problem now that countries like Germany, Finland are having to sort of promise their parliaments that, look, the banks are going to have to take some of the pain, private sector involvement has to be there, then if you do have this sort of system of fiscal transfers, as you say, where you discount private sector involvement and you continue to have, Germany funding Greece and so on, is that not going to increase domestic opposition in these countries in the coming months?
I think it may do. I mean, I think what most concerns us is that, already when you look at this year's programme targets for Greece seems to be falling behind on its revenue projections. And so if it takes another 3 months, as was hinted yesterday, to sort of argue about this until September, by September it's going to be obvious that Greece needs even more money. So that's going to make the political climate even tenser. On the other hand, I think, from the European point of view, the politicians need to go out and make the case that actually, it's not a fiscal transfer. Greece is being lent money and it's actually paying good interest rate on that back.
Is that part of the problem for Greece?
But yes, it is. I mean, especially if some of this debt is extended to longer-term durations, 30-year horizons, you're looking at a situation where Greece will be paying interest rates, from Greece to the European core, for a very long period of time. So that's a fiscal transfer union in a very different sense, where the poor countries are paying the rich countries.
What about the austerity program and the opposition that we've seen within Greece itself? Because, many people saying that this sort of level of debt, they're not going to be able to pay it back. The high interest rate is a problem. They're not going to be able to access the market for a while to come.
Well, at all, ever, I think would be more like reality. I mean, I think this is the crux of the issue. I mean, the temptation, I think, particularly from a political point of view, is to treat countries as households. And so you sort of believe people who've borrowed money, they should pay it back. And I think that fundamentally that's the mistake, that basically countries and economies are not households. And what we need really for Greece is a complete rethink of the strategy, an appeal to something like a Marshall Plan maybe, something to get the economy moving and starting to get some growth in the economy. Because until there's growth, we're not going to be able to generate tax revenues. And without tax revenues, no, we're not going to be able to pay back the money that Greece is currently borrowing.
And then yesterday, I mean, we saw instability in the markets. We saw banks on the decline, insurance costs, borrowing costs rising for these weaker peripheral countries. So contagion very much making itself felt on the markets again. I mean, the longer that these talks drag out on Greece, is it more likely then that the situation becomes riskier for Italy, Portugal, Ireland?
Well, I mean, absolutely. I mean, what we've seen is this sort of a perpetual cycle of sort of risk on, risk off. And even in countries like Spain, where, I mean, we've been arguing for a long time that the macroeconomic fundamentals in Spain actually look much more positive. And there's a huge degree of clear blue water between Spain and some of the smaller, weaker European economies. But the problem is that for the investors that actually, invest in Spain, they continue to see spreads widen, narrow. And that makes it very difficult to actually hold those positions. And what we're really starting to see now for the first time is investors actually pull back and say, enough. We are out of this.
So these concerns are being effectively overstated in the markets and don't reflect the fundamentals, if you like.
I think in an individual country, you can make the case that an individual country's macro fundamentals look relatively solid. The problem is the wider European landscape, and this is really the sort of the point that I guess Moody's were making yesterday, is that when you look at the sort of the effort and the huge struggle, the tension that the Europeans go through in order to sort of put together a bailout package, the concern is that is not a very efficient process.
Just a very quick one, James, on questions that will be asked of the ECB today about what they accept as collateral.
Well, I mean, as again, from what Germany has basically put this option back on the table. This is the key question. I mean, there is, I guess, in the markets, but also probably from some of the policymakers, an assumption that the ECB will basically back down, that when push comes to shove, will they really let the Greek banking sector go bust? And the answer is no. But I think, certainly what the ECB are telling us is that this is not something they can negotiate over. Unlike the collateral rate rules for ECB money market operations, which basically they've waived for Greece, and they said they'll take, any level of rating. This is a different issue. The ECB's mandate arguably legally states that the ECB is not able to
So they
trade.
won't have the flexibility to bend the rules, if you like.
It's not an ECB decision. This is something that potentially could be challenged legally in court. And so the ECB is saying that, this is not a variable they have a degree of freedom over.
James Nixon, Chief European Economist of Societe Generale, really enjoyed talking to you. Thanks very much indeed for your analysis.